Hello, everyone, and welcome to our October edition of Markets in 2 Minutes. This is Darrell here from the WealthSpire investment team. We saw volatility creep back into the marketplace over the past couple of months, especially with respect to interest rates, where we saw the yield on the 10-year Treasury, for example, surge above 5% for the first time since 2007. This has all been driven by the continued speculation on how persistent inflation will be and whether or not the Fed will be able to engineer a soft landing. And as we've seen for much of the past couple of years, we find ourselves in this good news is bad news type situation for the markets. And this chart here helps to illustrate what I mean by that. What you're looking at here is the Citi Economic Surprise Index, which tries to measure how well the economy is performing relative to expectations. Any period where the index is above zero is a time where the economic data is coming in stronger than expected. And anything below zero indicates that economic data is coming in weaker than expected. And you can see here that for the entirety of 2023, we've seen data surprise to the upside. And that has been a significant contributing factor to rates moving higher because it's been interpreted by the markets as giving the Federal Reserve additional room to keep hiking interest rates in its effort to continue fighting inflation. And so ultimately, it's logical to then ask why the economy has continued to exhibit more resilience than anyone expected it to. And one key detail that's been flying under the radar a little bit is the amount of fiscal spending that's been taking place and continues to provide fundamental support for economic activity. This is a chart published by Bank of America, and it illustrates the amount of spending from some of the recent legislation that's been signed into law, which is money that is currently and will soon find itself circulating in the economy. You can see from the chart here that between the Inflation Reduction Act, the CHIPS Act, and the Infrastructure Bill, we're looking at an anticipated $80 to $100 billion per year in net spending all the way through the 2028-2029 period. So there's still a pretty significant amount of fiscal support that will be in place for multiple years into the future, in addition to all of the COVID-related spending that's already taken place. And we're of the view that this fiscal support has been a key factor in keeping economic activity more robust than might have otherwise been the case, and as a result, has contributed to volatility in rate markets. And this will be important to keep in mind going forward as the endless speculation about the timing of the next recession and all of that probability-weighted analysis continues to ebb and flow in markets. And in the meantime, we'll continue to keep an eye on the marketplace and come back to you with another update soon. So thanks for listening.